When you think of competition in business, for most people, the first thing that comes to mind is pricing. In other words, a company cutting prices to steal customers from its rival. And that way of thinking wouldn't be wrong, it would just be narrow. You see, competition encompasses more than just pricing. Businesses compete on pricing, yes, to be sure, but they also compete by increasing advertising, by hiring more talent, by securing materials, and increasing supply. So in this video, I'm going to highlight a few characteristics about business competition and what it means for investors. Of course, I'm also going to offer two stocks investors can buy now, and I'm going to connect those two stocks to the discussion on competition.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's get started here. Now what I have is a chart from Michael Porter's competitive strategy, and Michael Porter is one of the best experts on business competition. His book Competitive Strategy is one of the best resources if you're looking to learn more about competition in business. So this is from Michael Porter's book Competitive Strategy, and this slide, I'm going to focus your attention here on the top part, and it's looking at rivalry among existing business firms, and it's got some charts leading up to it. So let's start with the top part here, and potential entrants or the threat of new companies coming into the industry. If the threat of new entrants coming into the industry is high, or in other words, if it's easy for new companies to jump into the industry, then that increases competition, because when things go well, you have new industries coming in. And so the industry specifically that we're going to talk about in this video is the streaming content industry. And so let's think about that in the context of threat of new entrants in the streaming content industry. Now, it's not easy to launch a streaming service, right? You've got to have a lot of content already, or you've got to license that content from another provider, and that will be expensive, and you might not be finding a willing participant that will license you their content, because most of the major studios, they have their own streaming service now, so they're hesitant to license that content out to somebody else. So when you're thinking about the streaming industry, the threat of new entrants, it's very low, because it's very difficult for a new company to launch a streaming service now after all of the existing studios have launched their streaming services. The next part here, let's focus on the bargaining power of suppliers. And suppliers, you could think of content creators, you could think of actors. How easy or how difficult is it for content creators or studios to find people willing to work in making movies or being part of movies? And in my opinion, it's not very difficult, right? You have a lot of willing participants in the industry, actors, directors, producers, and so on and so on. The film industry or the content industry is one that people are excited to join. They're willing to join. They're willing to even take lower wages in order to participate in that industry, right? Think of the next big Disney movie, right? Let's say they're making a new Marvel Avengers type movie, and there's a spot open for one of the lead roles. There would be a lot of willing actors that would want to take that lead role, even if the pay is not great, because they can see that as a launching point in their career in the film industry. So the bargaining power of suppliers is on the side of the companies like Disney, like Netflix, and others that are looking to create new films, new content, right? So that's in their favor as well. Then let's focus on the threat of substitute products or services, right? What else can customers do instead of entertaining themselves with streaming content, right? So you could think of maybe playing video games, listening to music, maybe going out to watch a movie at the movie theater, maybe going to a theme park, right? So looking at all of those substitutes, what you'll realize is the price to content, the price to value relationship is strongly in favor of content creators, right? You can get a subscription to Netflix for less than $20 a month, and that could entertain a family of 4 or 5 all month. They've got enough content to serve that entire family. So imagine if you spend, I don't know, 10, 20 hours a week watching content through spread out across your family members. That cost per hour of entertainment is extremely low when you're looking at streaming content. So that's strongly in its favor. And finally, let's look at the bargaining power of buyers. What can buyers do in this industry? And this is one where initially buyers had strong bargaining power, right? All of the new streaming services that were coming out with very low introductory prices, but that's changing. And I'm going to show you a little bit later in the video how all of the participants in the industry are increasing prices. And so buyers can't look around and say, well, you're raising prices, so I'm going to go to your competitor because they're not raising prices. Well, almost everyone is raising prices, so you don't really have a choice as a buyer in terms of switching to another streaming provider for lower prices. And so that's in its favor as well. So we could look in the 4 main categories of competition. The streaming industry is looking very good from the investor perspective, right? We're looking at it from the investor perspective. It's looking pretty good. Now, let's look at the next chart here, figure 1-2. And this looks at entry barriers and exit barriers. And this has a strong correlation with returns for investors as well. When you have a company that has when you have an industry that has low entry barriers and low exit barriers, you have low and stable returns. If you have high entry barriers and low exit barriers, you have high and stable return potential. And this is where streaming industry is. You have high entry barriers, right? I talked about earlier, it's difficult for a new streaming provider to enter with their own streaming service if they're not already one of the major studios participating. And then the exit barriers, it's not difficult for, let's say, if Disney says, you know what, this streaming thing is not for us, it's not working out, we don't like where it's going. It's easy for them to just say, all right, let's sell our streaming business. Let's license our content instead, or let's just sell all that content we have and move out of the streaming industry altogether. And the same can be said of many of the other streaming providers like Netflix. Let's say Netflix says, you know what, we want to exit the streaming industry. We just want to sell. We don't think the industry looks good. We just want to sell. It'll be easy for them to sell their intellectual property, their business overall, parts of the business, certain franchises in the business. So it's easy for any of the streaming providers to exit the industry. And so when you have high entry barriers and low exit barriers, that leads to high and stable returns, which is exactly what investors are most looking for, right? You want high returns. And also, if you have a choice, you would also want stable returns. You don't want the choppiness and riskiness, right? You want stable returns. And so that's what the streaming industry right now operates in. And so that's why I've highlighted 2 stocks in the streaming industry that I'm going to recommend buying, because it's facing very friendly competitive forces, very friendly competitive forces. Let me start with highlighting the industry leader, Netflix. Okay, so Netflix in the last 9 years has raised its prices in the US 4 times. That means on average prices have gone up every other year. Every subscription tier has went up by at least 12% this year. And in fact, over the last decade, since 2010, the standard price for Netflix has increased by 63%. 63% increase in the standard price. And when you have the industry leader increasing prices, that makes it easier for other participants to also increase prices, because they look at it like, if we are to raise prices, competitively speaking, we're still not going to lose relative pricing power compared to a rival. So if your rival increases prices and you increase prices and you still have the same price, then you haven't lost relative positioning. But if your rival does not increase prices and you increase prices, now you're less friendly pricing compared to your rival, and customers can choose your competitor over you if price is a major decision point. So when everybody is raising prices, that's good news for everybody in the industry. Well, not the customers, but for the companies and for investors, it's good news because now you have the ability to raise prices without losing market share, without losing relative positioning. So the first company I'm going to recommend as a buy to capitalize on this easing competitive industry is Disney. This is their main categories of business here is their studios, the parks and experiences, and streaming. And I'm going to highlight a few key characteristics here of these three categories in their business. First, look at what they're talking about here. Disney's talking about rationalizing the volume of content we make, what we spend, and what markets we invest in. Also, we're looking at opportunities in pricing, marketing, advertising, and account sharing. Account sharing is something I haven't talked about yet. That's another way that streaming participants are making it harder for customers to consume their content without paying for it. In other words, it's going to increase the average revenue per user these companies generate because there won't be one family that's sharing the account with 5 other families and maybe each of them contributing a small portion. Now, each of those 5 families needs to pay for the streaming service if they want access to it. Another thing these streaming providers have been doing is decreasing the amount of money they're spending on content. So not only are they raising prices, but they're also decreasing the content, right? So they're increasing prices and they're lowering spending on the content. So they're benefiting from both sides of that equation in offering less content, so less spending, and then higher prices. So the profit expansion, the profit formula is working well. That being said, the big risk, the big downside for Disney is the transition, right? The transition from going from the linear networks over to streaming consumption. That's where Disney's getting hurt. You can see the linear networks revenue year over year in the third quarter fell from 7.2 billion down to 6.7 billion. So 500 million decrease in revenue from the linear network. And that was almost completely offset by the direct to consumer business, which increased by 400 million in revenue. So it's not like Disney is losing customers. It's that Disney's customers are switching from the way they consume the content. Instead of consuming content through linear networks, they're consuming the content through streaming. And streaming is not yet as profitable as the linear networks are. But given the industry characteristics, I wouldn't be surprised if in a few more years, maybe 2, maybe 4 more years, that the streaming industry becomes just as profitable as the linear network industry was in before 2012, 2013, when streaming really started to disrupt the business and cord cutting really became more popular. It's just the transition is messy, and it takes time to transition from one consumption model to another, and that's hurting the business to be sure. And you can see in the operating income as well, linear networks operating income falling from 2.5 billion down to 1.9 billion. And the direct to consumer segment is still not profitable, but it is improving. It lost 1.1 billion in the same quarter last year. In this third quarter, it only lost 500 million. So it's making progress on that front, getting to profitability. And given the industry characteristics with the easing competition, I wouldn't be surprised if in the next couple of years this segment becomes just as profitable as linear networks. The other company I'm going to highlight is Paramount. Paramount is also going through the transition from shifting its business from linear consumption to the streaming side, and its streaming business is doing well. Revenue increased 40% year over year, subscription revenue was up 47%, advertising revenue was up 21%. The company's subscribers reached 61 million, which was 700,000 additions in the quarter. So it's going well. It's adding a lot of customers. That side of the business is doing well. However, just like Disney, the company's linear network is struggling. Affiliate and subscription revenue declined by 2%, advertising revenue declined by 10%, and so the adjusted operating income before depreciation and amortization was down 13% year over year. So the same forces that Disney is going through, Paramount is experiencing as well, transitioning from one consumption model to another. But the good news is, like you saw, they're not losing customers. It's just the customers are switching from the way they used to consume the content to this new way of consuming the content. And so already Paramount and Disney stock is down 58% off its high, and Paramount Global stock is down almost 85% off its high. So this transition, investors are not happy about it, and they have a right not to be happy about it. The companies are losing a lot of profits from their linear network segment, transitioning into the streaming segment, and it's not sure that the streaming segment is going to be as profitable as the linear network segment. Now, I've been forecasting or speculating that they could be, but still, you don't know for sure if they will be. Investors like a sure thing. Investors like stable returns, like we talked about earlier. And going from linear to streaming, it's uncertain. And so these stocks have been punished as a result of that. And that's justifiable. That's justifiable to be sure. But now, because of these sell-offs, the stocks are not expensive. And they're downright cheap, I would say. So you have the Walt Disney Company trading at a forward price to earnings of 14.62, and you have Paramount trading at a forward price to earnings of 10. And what I have here is a dashed line of the average of this valuation going back the last 3 years or so, and these stocks traded at a forward price to earnings over 33. And so you're getting them at a fraction of their average valuation, let alone a fraction of their all-time highs, and you're getting these companies when the transition to streaming is, I would say, it's far enough along. I would say it's in the sixth to seventh inning in terms of transitioning the business over to the streaming model. It's not completely there yet, but it's more than halfway there to transition. Most of the work has been done. So for all those reasons, I think that Disney and Paramount are two stocks that are operating in industries with very friendly competitive forces that I think investors can buy now. All right, but before I let you go, if you've gained any value from this video, which you probably have if you've made it this far, please subscribe to the channel. It'll really help create more videos just like this one. Thank you so much for watching.